Hello and welcome to the Tax Roundup for October. And what a huge month it's been. We're going to start by looking at a potential softening of the penalty tax regime for both small business and for individuals. Then we're going to take a look at a quirky issue from the new withholding tax regime that came in on 1 July and what happens when a client dies but hasn't actually completed the forms necessary to avoid the withholding tax. But first up, the huge news, of course, for the month is the release of the second tranche of superannuation reforms and those changes from the budget announcements. Garth McNally is going to take you through the details. Across to you, Garth.
The government has recently released an update to three of the proposals which were initially announced in the recent federal budget. The first change we're going to look at is the initial proposal to remove the work test requirements for clients aged 65 or above. Currently, you'd be aware, those clients do need to be gainfully employed or meet the work test to make contributions to super. The budget proposal was to actually remove that requirement, but unfortunately in the more recent round of changes that has now been taken away. So moving forward, clients will still need to meet the work test to contribute to super where they are 65 years or above. The second change is around the concessional contributions cap. Currently, you'd be aware that the contribution cap for concessional contributions is $30,000 for most people or $35,000 for those clients who are 49 or above, assessed at 30th of June of the prior year. From 1 July 2017, that concessional cap will drop to $25,000 for everybody. Now, as part of that reduction, the government also proposed that any unused portion of that $25,000 could be carried forward for a period of 5 years, so a rolling 5-year period from that contribution year. The initial proposed start date for that was 1 July 2017, but unfortunately that has now been delayed to 1 July 2018. So the carry forward rule, or the unused carry forward amount, is still allowed, but it won't start until 1 July 2018. So just a delay of 12 months. The big change which was announced was around the non-concessional contribution space. In the budget, we had a proposed lifetime non-concessional contribution cap introduced of $500,000. And that was essentially retrospective. It was backdated to take into account all non-concessional contributions from 1 July 2007, and again capped at $500,000. That has been scrapped. We're calling that a backflip. That has been scrapped and now been replaced with a new annual non-concessional contribution cap of $100,000 with the ability to continue to use the bring forward rule, so allowing next 2 years worth of contributions, so you can put $300,000 into super. So essentially the annual non-concessional cap will be reduced to $100,000 under the new proposal with the bring forward rule of $300,000. Now that's not proposed to start until 1 July 2017, so the current year really is an action year. Where possible, clients should try and maximise the current non-concessional caps of 180 and 540 where possible. Now where a client does exceed the current annual non-concessional cap of $180,000 in the current year, there will be some transitional rules to pick up the reduced caps going forward. That can be quite a tricky area, so we do suggest you do look at the Treasury announcements on that because there are different transitional caps depending on which year your client triggered that bring forward rule. The call to action at the moment is probably to maximise non-concessional contributions where possible for your clients under the current rules. The last point to note around the non-concessional contributions is the ability for your clients to make non-concessional contributions when their superannuation balances total less than $1.6 million. As soon as your client's balance hits $1.6 million in super, they will no longer be able to make non-concessional contributions. Under the current proposals, that $1.6 million will be assessed at 30th of June of the prior year. So if in that year the client's balance is already 1.6 million or above, they will no longer be able to make non-concessional contributions moving forward. This is going to open up a lot of planning opportunities and strategies for clients in regards to getting that 30th June balance back below the 1.6 million. So when that occurs, they can make contributions at least for that next year.
Mike Carruthers is now going to take you through that proposed softening of the penalty tax regime.
Now, interesting development this month with the ATO releasing a consultation paper to stimulate discussion, amongst the broader community around some proposed changes to the penalty regime, particularly for individual taxpayers and small businesses. Basically, what the ATO is proposing at a very high level is that penalties that currently would apply for failure to lodge documents or failure to take reasonable care in preparing income tax returns or activity statements will actually be waived completely for your first offence. So the ATO is basically saying that, look, understand that people sometimes make mistakes, and there's concern amongst the community, I guess, that in some cases where people do make mistakes, however innocently those may be, that sometimes the penalties are disproportionate to the mistake that they've made. So the ATO is trying to address some of those concerns, and this is one of the proposals that they've come up with. And at this stage, they're just seeking input into how those rules might operate. So basically what the ATO is suggesting is that if you have failed to lodge a document or you've made an error in a return or an activity statement, and the ATO says that is due to failure to take reasonable care, then the penalty that would otherwise be imposed can be waived. The ATO can basically automatically waive that penalty the first time you make one of those mistakes. And the way it would work is that the ATO would let you know. They would say, you made this mistake, this would have been the penalty, but we are waiving it in this instance, but be careful because next time you won't have the penalty waived. The other thing the ATO is considering is resetting that period. So maybe after 3 or 4 years, as long as you haven't had any more mistakes in that period of time, you actually get, again, put back into that first chance scenario where you could have the next penalty waived again. So really interesting concept from the ATO, quite different, I guess, to what we might see at the moment, where if something like that happens, you have to apply to the ATO to have those penalties waived or remitted, and you may or may not be successful depending on your circumstances. So we'll see how this develops. Obviously, it's probably early days. It seems that the ATO has done some thinking on this. It sounds like they've read some of the academic literature. They've looked at other tax jurisdictions to see things that may or may not work in terms of not going too far in punishing taxpayers, but also trying to motivate and encourage compliance. And it seems like they're thinking this might be an idea. Now, in terms of this applying to individuals and small businesses, I don't think the ATO has necessarily finally settled on what is a small business. They've indicated that they're thinking around the $2 million turnover mark. So we'll wait and see again where that ends up. But at this stage, we're talking about individuals and small businesses under $2 million turnover.
Finally, we're going to look at the withholding tax and what happens when a client dies.
Now, this month we're looking at a legislative instrument that's been issued by the Commissioner to address a particular issue with the new withholding tax rules that apply to certain transactions relating to property in Australia. And these were the rules, you might recall, that started on 1 July 2016 and that are triggered in a number of situations, but mainly where you have someone selling property worth $2 million or more, and where either the vendor is a non-resident or they're an Australian resident but they haven't provided a clearance certificate to the purchaser. And that would normally trigger a withholding tax obligation. The purchaser is required to give the money to the ATO. Now, one of the little cracks, I guess, that slipped through when the law was introduced to Parliament and passed into law was what happens when someone dies and they're owning property that's worth more than $2 million. And what that meant was that you can actually have the situation under the rules where someone dies owning, let's say, a commercial property that's worth $3 million. Their death would trigger a withholding tax obligation if they didn't have a clearance certificate that they had given to either their executor or joint tenant who might kind of take over ownership property upon their death. Now, this issue has been raised with government. We actually raised it through the Board of Taxation, and fortunately the Commissioner has come up with a pretty simple solution, and hopefully one that will be pretty effective. This legislative instrument that has been issued in the last month means that the Commissioner has just automatically varied the rate of withholding in that situation to 0%. So the rules are technically triggered in probably lots of cases, but the rate of withholding is reduced to nil, which basically does away with the problem. Now, if that hadn't been the case, what would happen was the withholding tax liability would be triggered. The purchaser or the executor or the beneficiary of the estate would actually be liable for a penalty equal to the amount that should have been withheld if they didn't meet that obligation. In most cases, they just wouldn't, because that's just the way it would work. So, sensible outcome. Fortunately, it's good to have a bit of clarity on this and have a proper position on it. So this will be relevant where someone dies and an asset that they own passes into their estate. It will also apply where the executor then transfers the asset to a beneficiary of the estate, for example, under the terms of the deceased's will. It will also apply in a third situation where someone dies holding property under a joint tenancy arrangement and where their interest in the property passes automatically to the other joint tenant. So those three situations, which could otherwise have triggered some pretty nasty tax implications, now we've got a position where that problem has pretty much been resolved, which is great news.
And that's the tax roundup for this month. The rate of change is quite fast at the moment, even though you wouldn't know it from the media coverage of a lot of the issues. But if you want to stay on top of change and you want to make sure that what you're saying and the advice you're giving to clients is right, then take a look at what the Knowledge Shop membership offers. Our help desk can just give you that extra confidence to make sure you manage and navigate these changes that are coming through Parliament. See you next month.